Good morning. Thank you for joining us for today's webinar. We are pleased to welcome Michael Lynch with Hartford Funds to bring this message to you. Just a few housekeeping items. At the end of the presentation, a survey will pop up on your screen. We ask that you please take a minute and fill it out. If you have any questions or there is something you would like to hear more about, please let us know in the comment section of the survey. And just a few disclosures here. Securities offered through LPL Financial, member FINRA, and SIPC. Investment advisory services offered through Henderson Brothers Financial Partners, LLC, an SEC registered investment advisor and separate entity from LPL Financial. LPL Financial is not affiliated with Henderson Brothers. And without further ado, I'm going to turn the presentation over to Mike. Mike, go
Well,
ahead.
terrific. Terrific, Leanne. Thanks very much for the opportunity. I want to thank the whole team at Henderson Brothers for having us today. We know it takes a lot to put these on, so truly appreciate the efforts. And folks, thank you most importantly for carving off some time out of your day. We certainly know time is one of the most precious commodities, so having the opportunity to spend a little time with you, it's much appreciated. And hopefully to be able to share a good message and a good concept such as Social Security. It certainly is on quite a few of our minds. I just turned 62, so it's certainly on my mind, and it's something I struggle with. So if you have some challenges with it, unfortunately, you're in good company because many of us do. I think one of the challenges, quite honestly, with Social Security is some of the flexibility. It'd be much easier if we just said it reaches a certain age, this is your option, or you wait till this age, this is your option. Where now we have so much flexibility, and I think it's a good thing and a bad thing. And I think it requires some planning and it requires some effort, quite honestly, to look at what's the best option for me. As we go through this presentation, there's really no right or wrong. Again, it's what's the best option for me? What's the best option for my spouse and for my family? So ultimately, that's our goal today to kind of go through this topic and hopefully, kind of give you an update as to where we're at and then talk about some options that are available to you. I think anytime I do a Social Security event, whether it's in person, which I do quite a few, or webinars, which I certainly cherish, and I think it's a great opportunity. But I almost think, it's bringing the elephant in the room, if you will, and address that elephant, which is the future of Social Security. Do we think Social Security is going to be here going forward? Now, I certainly don't have a crystal ball, but our thought at Hartford Funds is Social Security is not going to go away altogether. We think it's too important a social program. And it just celebrated last year was his 90th birthday. And I think if you know anybody in their 90s or have known anyone in the past that, was in their 90s, they probably have changed a little bit over the years. I think that's where we're at with Social Security. We don't think it's going to go away altogether. We certainly don't think it's going to stay the same as it has for the past 90 years. So we're kind of in that change camp. And the challenge is what types of changes? Will we see kind of drips and drabs, which we've seen in the past as far as changes to Social Security? Or will there be sweeping reform in the next couple of years? That's what we need to really stay in tune with and stay in front of. So as I mentioned, 90 years of age, Social Security was first enacted in 1935. It was part of the New Deal with FDR. Think about that package back then, sweeping reform, a number of things terrific for the government. But one of the challenges with Social Security was thinking about life expectancy. So when it was first rolled out in 1935, the average life expectancy for a male was only 59. You didn't collect your benefit payment back then until 65. So if everybody does the math, it was a great program for the government, not such a great program for the individuals, right? Because not many folks actually live long enough to receive more than a year or two of their benefits. Although there is an interesting section out there, the history of Social Security, and it talks about one of the very first recipients of Social Security, Miss Ida Mae Fuller, where they claim she was the very first recipient. Now, based on her age and timing, she only paid in 2 years, $24.75. She then went on to reach age 100 and collected $22,000 over her life. But again, she was the rarity, where now she's starting to become the norm. And I think that's part of the challenge with Social Security. Many of us on this call today probably know someone in their 80s, 90s, if not hundreds. That's the challenge with Social Security, is it really hasn't kept up with that longer life expectancy. So we want to talk about and certainly be educated as to what our options are. I think it's important when you think about Social Security, think about it as a source of income in retirement. Even from day one, it was never designed to be the sole source of income in retirement, but rather a source. So a great analogy, and I think a great visual, is the three-legged stool. You may have heard this in the past. I think it's still a terrific opportunity to kind of think about my sources of income in retirement. And for many of us, hopefully there's two, if not three legs, meaning Social Security. Maybe a little wobbly, maybe changes. We want to prepare for that and certainly be educated about it. Pensions, kind of a foreign term nowadays. Many companies, unfortunately, have kind of eliminated their pension, maybe a stronger 401k or a different type of retirement options. But those have almost all but seen to exist or ceased to exist. The one leg we fully control is our savings and investment leg, meaning our retirement plan, our 401k, Roth 401k, our IRAs. Maybe it's a Roth IRA, whatever the case may be, after tax savings accounts. That's the leg we fully control. That's the leg we really want to make sure that we shore up as much as we possibly can. So again, I applaud Henderson for offering this type of education to really help you understand kind of that view of retirement, that view of your future from a financial perspective, and thinking about all these different sources of income. So it's important to be educated about Social Security, think about what my options are, but it's equally as important, probably more important, to make sure that leg, that savings and investment leg, am I doing everything I can? I think the day and age we're in, quite honestly, in future generations, the responsibility for successful retirement is being pushed more on us. I think of my dad often when I see this analogy or this example because he was a retired postman. So he was getting Social Security, he was getting a strong pension, and he had some savings and investment. If I had to guess, I don't think he probably saved as much as he needed to because he kind of thought, gosh, I've got two partners, right? Social Security and pension. And they were strong opportunities for him. Where now, again, that's changing. So we're really being required to do more and more that we can to have a successful retirement. So again, it's an opportunity for us to really be educated, think about what our options are, and then proceed in the best manner possible. So today we want to talk a little bit about timing from Social Security perspective. It's usually the first question I get, the last question I get, when should I take my benefit? Unfortunately, as I mentioned, the Social Security, there's really no right or wrong. We just want to make sure you understand what your options are available to us. We want to talk about the role of work. For many of us on the call, we may want to continue to work. We're hearing more and more from folks now is 65, 67, that hard and fast finish line. Folks may want to continue to work a little bit longer. Maybe not in the same company, maybe not in the same role, maybe a new type of job, maybe a dream, type of opportunity. But I think that role of work is continuing to evolve. It's important to know about that, know some limitations that are involved taking my benefit and continuing to work. Everybody's favorite on a Tuesday afternoon, right? Talking about taxation, or Wednesday afternoon, I should say, talking about taxation and the opportunity from a tax perspective. Unfortunately, not much good news, but we want to talk about our options that are available to us and making sure that we know. And there's been some recent changes, so I think a little bit of good news, but we want to think about from a tax perspective and have that awareness. And as I mentioned, awareness, really thinking about what our options are. At the end of the day, what am I actually entitled to from a benefit perspective? So again, from a timing perspective, if we paid in the Social Security or married someone who's paid in the Social Security and we qualify, we're able to take that benefit as early as age 62. Now, again, not to say it's right or wrong, but generally speaking, that's our lowest benefit. And it may have to last us another 20 or 30 years. If I take my benefit at 62, it's generally about 70 cents on the dollar versus maybe waiting a little bit. And you see, I can wait till 63, 64, 65. And a rule of thumb with Social Security is the longer I wait, the greater my benefit amount is. Now, it's interesting, kind of that dark blue or black section, FRA, full retirement age. So that used to be 65. For all of us on the call today, our full retirement age was 65. Well, a couple of years ago, they made some changes to Social Security. And one of the changes they made was to push up full retirement age from 65 to 67. Now, the good news is they didn't just do this overnight. They gradually increased that. And you see in the middle, they grandfathered people in. So, for example, if you were born in 1956, your new full retirement age is 66 and 4 months. If you were born in 1958, 66 and 8 months. I was born in 1964, so my full retirement age is 67. Why that's important is that's generally your maximum benefit. So if my goal is to try and max out Social Security or try and get the most I'm entitled to, I may want to think about working until full retirement age or not filing until full retirement age. Now, it is interesting. You see that delay section kind of pushing that speedometer from 67 to 70. That's an interesting section. That's for someone that maybe doesn't necessarily need their benefit, doesn't want their benefit. Again, wants to really max out and try to let their benefit grow dramatically. Every year between full retirement age and the age of 70, you can delay your benefit. So I choose not to take it. I'm working hard for funds. I'm 68, still making a nice living, don't necessarily want or need my Social Security benefit. I can delay it. And every year you delay your benefit between full retirement age and the age of 70, your benefit is actually increased by 8%. So again, I continue to work at Hartford, 69 years of age. I continue to get that increase. Now, it doesn't mean you have to take your benefit at age 70, but what it means is that benefit incentive, that increase, stops at the age of 70. So I have that flexibility. So again, I could file as early as 62. I could wait till 64, 65, and so on. I could wait till full retirement age, or I can really look at the delay section. So I think what's been helpful is maybe think about it from a numeric standpoint. So again, if I file early, in this example, we assume someone is 67, full retirement age, and their benefit max is $2,000. Well, if they filed early at 62, it's about $1,400. You see that gradually increase. Now you see that green section after full retirement age. Again, maybe I continue to work, don't necessarily need my benefit, or I stopped working and I'm looking at other sources of income. I can let my benefit continue to grow up until the age of 70 if I choose to. Now, what's been helpful, and I think sometimes we struggle with, when should I take my benefit? When's that right age or that right time to take it? Maybe replace the word when with the word what, meaning what income do you need? And maybe take a step back and think more globally, or maybe, a little bit larger. What income do I need on a monthly basis in total? Is it $5,000 a year? Is it 10,000? Whatever that number is. Have I thought about putting pen to paper? And generally, it's one of the more challenging things, but I think we have to start thinking about it. If I'm going to enter retirement, about how much do I need? Then when I get that number, how much do I think I need from Social Security? Meaning if, you kind of do the math and you say, gosh, I need about $1,400 a month. Well, good news. You can file as early as age 62, or maybe I can choose to wait. If you do the math again and it says, well, I need about $2,000 a month, we may have to wait a little bit closer to full retirement age. If you say I need a little bit higher, I need about 2,500, may have to come up with a plan B, right? Or maybe wait until age 70. But I think it's been very helpful. Instead of really focusing on an age, let's focus on a dollar amount. To some extent, if you can kind of come up with the what, the when kind of fills in itself. So it's an interesting exercise to go through. And again, I think it's more important to take a step back and say, what do I need total on a monthly basis? And then what am I looking for from Social Security, knowing I've got hopefully those other sources of income as well to help. But I think it's a great first step. Now, a couple of things to note here. If you're not sure what your full retirement age is, I will encourage you to go out to ssa.gov. So the Social Security Administration's website, ssa.gov. It's one of the best resources out there. Once you go out, you can set up an account. Once your account is established, you can run a quick calculation. You get some information, specifically what your full retirement age is. And it'll tell you what you're entitled to at 62, what you're entitled to at full retirement age, looking at age 70. I will also add that if you have an extra minute or two once you set up the account, just take a look at the information specifically about the sources of income or reportable income over the years. So Social Security tracks from the time you started working, maybe you were a teenager or in your 20s, until today, and it has that income reported. Now, go out there and take a look at it with a grain of salt, right? Many of us don't remember what we made when we were teens or in our 20s, but I do know for about the past 5 or 10 years approximately how much I've earned. Just make sure that information is correct. Now, I think honestly, about 99.9% of us, I apologize, I'm fighting a bit of a cold, so I apologize. But I think 99.9% of us, that information is going to be accurate. Now's the time to just double check that. So you have that opportunity going out to ssa.gov, set up an account. It'll give you an approximate of what your benefit is currently. Again, it'll give you kind of an estimate. And then more importantly, it'll tell you your full retirement age. But I think it's a good first step. And I think it puts you in a good position going forward to get an updated piece of information. And then it allows you to begin to have a conversation in more detail. Second, the role of work. As I mentioned, that's continuing to evolve. I'm meeting more and more folks in my travels that are saying, I want to continue to work in some shape. Maybe it's part-time, maybe it's continuing to work where I'm at full-time. Um, I think it's terrific. I think for many of us, it's kind of what we do. It's what we've been doing. It's who we are. And I think that opportunity continues to exist. We just need to be aware of the fact if we do file early, meaning between 62 and full retirement age, that's generally filing early. That's kind of that time frame. There's a very small income amount that we're entitled to make. Once we make above that amount, unfortunately, Social Security literally withholds some money from our Social Security check. So you see the number there before full retirement age. So say, for example, I'm 62 years of age and maybe I've scaled back or I'm working part-time and I'm only making, say, $23,000. You see that 24,480. So I'm making below that amount. I'm fine. I can file for Social Security and I will get my full amount. But what if I get a pay increase or I work an extra day or I start to get paid, a different time, a different role and get paid a little more? Say I make 24,400 and say $82. For every dollar above that, in this case $2, they're going to withhold a couple dollars from my check. If I make another couple dollars above it, they're going to withhold another couple dollars. So if I'm making 30, 40, $50,000 a year, and I'll show you an example in a minute, I'm going to actually have a lot less in my Social Security check because this withholding kicks in. Now, again, a couple things to note. It's prior to full retirement age that it's important. The cap is very small. It's per person. So when we think about Social Security, it's really individually based. Meaning if my wife, which she hasn't worked outside the home in about 10 years, then the cap would not apply to her if she chose to file. Because I continue to work at Hartford Funds, it would affect me, but it would not affect her. So it's individually based and it's only on earned income. So if I have some investment income or I have some pension income, it's not going to be affected. But again, as I start to climb above that dollar amount, unfortunately, the withholding kicks in. So every $2, a dollar is taken out of my check. Another $2, a dollar is taken out of my check. Now, the year I turned full retirement age, and again, everybody's got a different full retirement age. I can earn a little bit more. I can earn up to 65,160. But if I get above that, literally $3 above that, they're going to withhold a dollar from my check. Another $3, they're going to withhold a dollar from my check. Now, here's the good news. After full retirement age, I can, maybe I retire at 67, my full retirement age, and I'm sitting on the couch for a month or two, right? Really envisioning and thinking about what retirement's going to look like. Maybe another couple months, I'm still on the couch, and my wife looks at me and says, maybe you ought to go back to work, part-time, full-time, whatever. The good news is I can do that, or I can continue to work. I can earn a dollar. I can earn $10 million. The withholding will not apply. So the withholding is only prior to full retirement age. And again, it's individually based. Now, here's a quick example. Someone who's earning $70,000, say I'm 62, and I file for Social Security. And what I find a lot of folks want to file early because they're afraid about the program going away. Well, the concern and the question is, are you going to continue to work? So if I'm making $70,000 a year, and let's assume I make that for the next couple of years, I'm over that limit, as you see. Look in the bottom in the parentheses. I went from filing thinking I was going to get $2,000 a month. The withholding kicks in very quickly, and I'm reduced now to a check that I'm going to receive every month. It's only $103 because of that withholding. That's a tough one to digest. I filed thinking I was going to get $2,000 when I'm actually only going to get about $103. So approximately $1,900 each month is being withheld. If I continue to work for the next couple of years, every single month I'm going to get that reduction. Unfortunately, that withholding is going to kick in. Now, the good news is it is technically withholding. So once I either get below the limit or I stop working or I turn over full retirement age, that money is technically owed to me. So if they've been withholding for a couple of years, again, $1,900 a month, it's starting to build up very quickly, as you can imagine. I will get paid that back because I'm technically owed that money. The hard part or the challenging part is I don't get a lump sum check. It's not like they say, hey, Mike, we've been holding this for 4 or 5 years. We want to send you a check for it. They're going to pay me back, but based on my life expectancy. So I may see that $2,000 grow a little bit, but the challenge again is I don't get that immediately. But the good news is I will get paid that back, that withholding. So that's something you really want to think about. Am I going to continue to work? If so, approximately how much am I earning? Now, if again, I'm going to scale back a little bit or I'm going to get it below that amount, then maybe I'm in good shape. But if I'm dramatically higher than that, if you could do the math, if I'm earning $100,000 or more, I'm not going to get a check. So you kind of scratch your head saying, why would I file early? And on top of that, adds insult to injury. I'm not going to get a check at the end of the day. Now, everybody's different. I don't give tax or legal advice, but I think it's something you want to have a serious conversation about and kind of go through the process and see where I'm at from this earnings test, because again, it does kind of kick in. Taxation. As I mentioned, thinking about, the role of taxes. Now, unfortunately, for some of us, our tax liability and Social Security may be something that we have to kind of think about and have the challenge of potentially paying. So the way they calculate whether I have to pay taxes on my Social Security benefit, and hopefully you're working with a good tax professional that's helping you and kind of going through this process. But the math behind it is my modified adjusted gross income. So an important distinction, before we talked about benefit reduction and whether it was going to be some withholding, that just applied to me and it was just my earned income. Now we think about modified adjusted gross income. If I'm married filing jointly, that number's probably a little bit larger. It includes potentially, if I did have a spouse that was working, her money in the income. It also may include investment income or pension income. So you can imagine the number's a little bit higher. We have to add back in half our Social Security benefit, meaning if I was collecting $2,000 a month, $24,000 a year, well, half of that, or $12,000, that's going to be includable in that calculation. When you add those numbers together, that equals combined, or what they call provisional income. So if we do the math and that number is below 25,000 or 32,000 married filing jointly, maybe I'm just getting my Social Security benefit in retirement. The good news is we won't have to pay any taxes on our Social Security benefit. Again, sorry, I apologize. Excuse me. If I'm 25,000 or 34,000, 32,000 or 44,000, or $32,000 to 44,000, then up to 50% of my Social Security benefit is subject to taxation. Now, it doesn't mean you go into a 50% category. Thankfully, there is no 50% category today. It just means half my Social Security may be subject to taxation at the current rate. So again, for example, if I was collecting $2,000 a month, $24,000 a year, half of that, or $12,000, would be subject to taxation at the current rate. Well, if I don't file for another 4 or 5 years, I don't know what the current rate is, but we know about what it is, maybe high teens, low 20s. So that can help us do the math from a preparation standpoint. Now, you may be in that third category, that $34,000, $44,000 and above. Up to 85% of this, or majority of this Social Security benefit, may be subject to taxation. Now, the good news is the One Big Beautiful Bill was passed last year, and part of the One Big Beautiful Bill through the current administration was to look at Social Security benefits and to look at ways that they could reduce the taxation liability from a Social Security perspective. And what's most interesting about this is, honestly, this tax deduction has nothing to do with Social Security, meaning we don't have to file for Social Security to actually get this tax deduction. It's more of an age tax deduction than it is a Social Security tax deduction. Now, yes, the majority of people over age 65 probably are taking Social Security, so it does apply to some extent, but it's more age driven. So it's 65 plus, and it is individually based. So if it's a couple and we're both over 65, you see down in the bottom that married, well, then potentially both of us could apply and we could get up to $12,000 in a tax deduction. If it was just me and I was 65 and my wife is 2 years younger, say 63, well, one of us is over 65. So it's $6,000 potentially. So the tax deduction is put in place to try and ease the burden a little bit from a Social Security perspective. So the deduction is a max of $6,000 per person. If we have a married couple and they're both over 65, the max is $12,000, so it increases to $12,000. There are unfortunately some phase-out limits, and they start at 75,000 or 150,000 for marriage filing jointly. But again, I think the good news is it's a help. And I think what they're estimating, or at least the administration's estimated, about 80% of people that are over age 65 filing for Social Security benefits are going to get some assistance by being able to use this tax deduction. So I think it's a step in the right direction. Is the greatest thing in the world? Certainly not, but I think it's a step in the right direction. Because more importantly, I think what it tells us is our government's talking about Social Security, which is something we certainly need going forward. And we hope that that conversation continues. But again, I think it's a step in the right direction. And I think it's starting to help quite a few folks that have either taken advantage of it or maybe it's coming up in this coming year that they'll have that opportunity taking care of it. Some folks have also said, are there other things that I can do? Inquiring about other ways that I maybe can lower my tax liability. And one of the ways, and some folks have thought about, is potentially looking at Roth IRAs or maybe a Roth 401k. Maybe you have that option in your 401k plan, that Roth sleeve. And the reason being is it's not necessarily includable in this calculation. Now, I certainly won't say that Roth is right for everybody. I think you want to have a conversation. You have that opportunity of maybe converting some money from IRA to a Roth, although it's a taxable event, or maybe again contributing to my Roth 401k or contributing outright to my Roth IRA. But the reason it's not includable is if I hold it for long enough and I'm over 59 and a half, that money comes out tax free. I don't have to include it in that math. Meaning, I'm thinking about my sources of income. I've got my Social Security, and then I need a couple $1,000s out of my IRA or my 401k. Well, it's going to be includable. But again, if I've held the money for a long enough period of time, over 59 and a half, which we would be in this example, then I have the opportunity of taking that money out tax free. That's also not includable in this calculation. So I think, again, that's where you want to have a conversation and see, does the Roth make sense for me? Either Roth IRA or Roth 401k. Am I well diversified from a tax perspective as I'm entering retirement? So it's something to certainly have a conversation about and kind of go through the pros and cons and see if it makes sense for you. And then last but not least, from an awareness perspective, what are you actually entitled to at the end of the day? So hopefully some good background information around Social Security, but kind of where does the rubber meet the road to some extent? So for those of us that have paid into Social Security or again, married someone who's paid into Social Security and we qualify, we're going to receive one of three benefits in retirement once we file for Social Security. Either our individual benefit, a spousal benefit, or if we lose a spouse, potentially a survivor benefit. Now, what's most important about this is you get one of the three. You don't get two or three of the three. It'd be great if we did. You get one of the three, and you receive whichever is greatest. Meaning, if my own individual benefit is higher than the other two, well, that's the benefit I would receive. If I lost a spouse and that spouse's benefit was higher than mine, I could potentially get an increase and get that benefit. So I want to go through an example first of a spousal benefit. Now, the way the spousal benefit works is generally speaking, if a married couple and both individuals file, where there's an opportunity for us to look at these benefits and see which one makes the most sense. So I want to go through a quick example, and we're going to look at John and Angela. Now, just for a minute, we're going to forget about John. We're going to assume John's working, hasn't filed, so we're going to leave him out of the conversation for a minute. Let's assume equally that Angela's just recently retired. She's 67. She contacts Social Security Administration, inquires about her Social Security benefit. They do some quick calculations. They say, okay, you're entitled to $1,500 based on your work earnings. So she takes her $1,500. Now let's bring John into the equation. Let's assume maybe it's 5 months later and John recently retired. John says, his retirement thing's not such a bad idea, right? So he contacts the Social Security Administration and inquires about his benefit. Now, based on his work earnings, maybe he's earned a little bit more over the years. He's actually entitled to $4,000. Well, once John files, now Angela can go back to the Social Security Administration and ask about the spousal benefit. Now, the spousal benefit is up to 50% of the other spouse, or in this case, up to 50% of John's. Now, the key words there are up and to. It's not an automatic. You don't just automatically receive 50%. That percentage is based on both ages. Meaning in this case, if Angela's full retirement age and John is full retirement age, then yes, she would receive that 50% benefit. But let's assume John is 67. Angela's 62, and she's filed early. Anytime you touch the money, anytime you do anything early, generally the benefit or the amount is a little bit less. Same thing from a spousal perspective. So if John files, Angela inquires about the spousal, but she's only 62, she's going to get about 32, 35%. So she wouldn't get 50%. So to get that 50%, it's kind of the max, if you will. And again, it has to be over full retirement age. So as you see, half of John's is $2,000. Well, 2,000 is higher than what Angela is receiving of 1,500. So she technically gets an increase from 1,500 to now $2,000. So John gets his 4,000, Angela gets her 2,000, and they continue to get those benefits. Now, again, let's assume that Angela maybe was receiving $2,100 a month. John files and John gets 4,000. What happens to Angela? Well, nothing changes for Angela. She continues to receive the $2,100. So she wouldn't get a reduction because 2,000 is less. She would continue to get her own. So again, when it comes to Social Security, you generally have that opportunity of kind of laddering up or jumping up if that benefit, that new benefit on the table, is a little bit higher than your existing benefit. The key factor here is to get a spousal benefit, both spouses have to file. So that's why I mentioned specifically, let's forget about John for a second. Initially, why didn't Angela just inquire about the spousal benefit? Well, if John hasn't filed, it's as if John doesn't exist. So you're not going to be able to get 50% of zero, right? John's not in the equation. So John would have to file for the spousal to be applicable. And one important factor is not automatic. So you need to contact the Social Security Administration when something changes like that. Once John files, Angela needs to follow up. She needs to contact Social Security and talk about the spousal benefit. There are some parameters as far as length of marriage and all those types of things. SSA.gov has a great list, so you can inquire on that. But again, if you have that opportunity, it's certainly something you want to think about. Now, unfortunately, let's assume that sadly there's a death in the family. And I think the assumption here is that John dies about 5 years later. Now, based on his work earnings and cost of living adjustments, because it is 5 years later, John's new benefit now is about $5,000. John passes away, and at his time of passing, Angel, again, with cost of living adjustments, her benefit's up to about $2,500, $2,536. So John passes away. Now what happens to Angela? Well, since they're both over full retirement age, Angela now gets an increase to 100% of John's benefit. So her benefit would increase from $2,536 now to $5,000 or to $5,072, and she would continue to get that. Now, what's important to note is that increase. So Angela no longer receives the $2,536, she gets an increase to $5,000. Well, think about prior to their passing, as a family, as a couple, how much were they bringing in each month from Social Security? Well, it was about $7,500. Well, now she lost a spouse, but she also lost some of that benefit because now she gets 100% of John's, but she gives up, that other 2536. And it would say they already downsized. They thought about kind of saving and they kind of pulled back a little bit. Well, it's about a $2,500 reduction. Now, where this is important, and somehow, I don't know how, but I came up to this conversation with a neighbor of mine, and she was talking about the fact that I knew, unfortunately, she lost her husband a few years ago. And she was talking to me about some of the challenges she was having because she and her husband were small business owners. They paid each other the exact same amount for years. So the Social Security was the same. She said, I was receiving about $2,000 a month. He was receiving about $2,000 a month. Well, we had downsized to a smaller townhouse community, which we live in currently. So we downsized to one car, really tried to really keep an eye on our expenses. She said, technically, once he died, I got a pay cut because now all I got was my benefit, not both those benefits. But again, she's already downsized, right? And unfortunately, as we probably know, when you lose a spouse, your expenses aren't cut in half. They're only cut by about 20, 25% on average. She still has to pay the same property tax. She still has to put gas in the car and food on the table and milk and juice and eggs and all those types of things, which continue to increase, unfortunately. So it becomes a challenge. And it's something we want to think about and kind of have conversations about. If we do lose a spouse, how do we replace some of that income? So it's important to think about that. So as we kind of wrap this up, there's some questions I think you want to kind of digest and think about. And we talked a little bit about that role of work and that continuing to evolve. But I do think it's an opportunity for you to talk to the team. And if you have a time frame in mind, is it 62? Is it 67? Or I want to continue to work as long as possible. Life is the biggest unknown, right? But, and things get in the way, and we certainly know that things change. But at least starting to have a conversation about what do we envision, how long we were going to continue to stay active and stay busy. And I think it's helpful, again, especially prior to full retirement age. Again, I do think a lot of folks are literally kind of run into the Social Security Administration with their hair on fire saying, give me my check, but they continue to work. It is a real eye opener to realize that withholding kicks in. So that's something you want to have a conversation about. Do I need this income or is it extra income? It'd be great if it was, right? Extra income each month. Maybe I could use it to fund a 529 for the grandkids, maybe life insurance, maybe use it for a dream vacation or a combination thereof. But I think we want to think about those sources of income and where does this Social Security come into play? Will I have to pay taxes on my Social Security benefit? Now, again, I think we've seen some steps in the right direction from a tax benefit perspective and having the opportunity potentially for this tax deduction. Although, again, there are some phase out limits, but intentionally it was designed to really help folks over age 65 and specifically those folks that are taking their Social Security benefit, maybe ease some of that burden. And I think, hopefully we'll continue to have that opportunity. And then how long will I live? Hopefully it's a question you can't answer. Life expectancy is one of the biggest unknowns. One thing I will encourage you to do is don't compare our life expectancy to our parents and grandparents. It's really ours and future generations. The fastest growing population right now are people over age 100. There's more people in the United States and quite honestly in the world over the age of 65 than ever before. Most of us and many of us on this call are probably going to live, longer than we thought, certainly much more active, doing a lot more things in retirement than we ever thought, which loosely translates into we're probably going to need more money in retirement than prior generations. So we want to continue to think about that and have that opportunity. So I think, really when it comes down to thinking what's best for me from a Social Security perspective, it's really having conversations about thinking about all these different factors that come into play. So as we kind of summarize this again from a timing perspective, there's no right or wrong. I think it's what's the best opportunity for you. Try that exercise of thinking about the word what income am I looking for? Again, putting some pen to the paper, I think it'll put you in a better position. The role of work I've already mentioned continues to evolve. Taxation will stay on top of that. And I think what's most important from an awareness perspective is not only some of the things I've mentioned, but excuse me, but also thinking about the future of Social Security. Now, Social Security's been very open and honest, and unfortunately, they've been talking about potentially a pullback, a reduction in benefits, whether it's 2032 or 2033. So potentially, if Social Security doesn't have some changes, they may be looking at about a 20% reduction on benefit amounts. Again, potentially. Hopefully, we don't get to that point and something happens and changes, but also don't want to wait till that point. So I want to think about ways that I can try and save more for my retirement. Again, knowing that time frame, which isn't very far away. Again, I don't think it'll be 100% pullback. I don't think that, we'll see. Hopefully, we won't see. Again, I don't have a crystal ball, but there are some things that they have in play that they can do to stay in front of this. But what I mean is we want to make sure that we stay on top of this. If anything changes, if there's some announcement or something that causes us some unease, pick up the phone, talk to your financial professional, contact Social Security. We paid into this program. We have the opportunity of taking this money. We just want to make sure what the right time is from a perspective of what's the best option for me. So if there's something that's announced, I'm uncomfortable with it. Again, we have that opportunity. We certainly want to take advantage of that. So we have this opportunity again, SSA.gov, I think is one of the best resources out there. If you have the opportunity, one of the best tools, quite honestly, from SSA.gov is the search bar. Type in your question. I'm out there quite a few times a day. You type in your question, you'll get a response. You may not answer, may not understand the response. I scratch my head sometimes when I get some of the feedback, but there's some great information out there. It really is a really terrific resource. More importantly, having somebody like the team that's invited you to be on the call today, I do think Social Security is more of a local type of conversation. It's important that someone I have a conversation about knows my spouse, knows my kids, what my goals are, what I'm trying to do. It's not a one size fits all. It also is equally important to think about this as more of a marathon. It's certainly not a sprint. This decision is going to have to potentially, take care of me and really last for another 20 or 30 years potentially. So we really want to put the time and effort into it, just like anything else with that type of time frame. So, Leanne, with that, I'll turn it over to you. But again, thank you. I can't thank you enough on behalf of Hartford Funds for having us on the call today. And folks, I thank you most importantly for taking some time out of your day to hopefully learn a little bit more about Social Security.
Yeah, thank you, Mike, for the great presentation. And as a reminder, as each of you are closing out of this webinar, a survey should be showing up on your screen. Please take the 2 minutes it takes to complete this so we can serve you better. Thanks again for joining us today and have a great afternoon, everybody.
Thanks.